Guys, welcome back to the Investor Army podcast. Now, today we're talking about real estate investing and hard money lending. This business that we're in is capital intensive. So we're going to talk about on both sides of the fence, how to become a hard money lender, start a fund, and also if an investor, you're looking for money, what to look out for. We have an expert on here today, Wendy Sweet.
Hello. How are you?
Hey, Wendy, I'm glad to have you on here. I've been following you for quite some time. I think you're a really good guest to bring on to talk about this. I've heard you speak many times. You do a great job in public speaking. So go ahead and introduce yourself to our audience here and kind of tell them a little bit about what you're doing up there and, kind of what they can expect with this podcast.
Okay. My goal is always to educate people on the financial side of being in this business, because your finances mean everything. It determines whether you can buy a house or not, how long you can hold on to it. Everything about your deal falls back onto the financing. So it's important to understand as a borrower, but it's also important on the other end that you can be the bank too. And people need to know that if I can do it, anybody can. So my goal here today is to really give people other options, because the best seat at the table is being the lender.
Yeah. So, I mean, like if you're getting in this business, guys, you can't go buy houses without money. Or a lot of people jump in and, they may have inherited some money or they've done a good job saving over the years. But what happens if you saved up $500,000 and you go buy $350,000 houses? Now you're out of business, right? Or you basically have a limited business. How are you going to scale and how you're going to grow? And sometimes it takes a little bit of time to build a track record, to build credibility, to raise private money. So Wendy is a hard money lender, which is a professional lender, which we'll talk about today. She also has a fund and has a great opportunity if you want to invest to get a high rate of return, because, that's not always that easy to do. So where are you located, Wendy, and kind of what's the name of your company? And kind of how...
I'm sorry.
No, go ahead.
I'm ready to go.
She's excited, guys.
That's right. So I have a company with my brother. It's called Carolina Hard Money. I've been investing and lending since 2003, although Carolina Hard Money was created around 2012 is actually when we started that. And it was because my brother's a genius, and we lend in the Carolinas. So he's thinking, internet SEO kind of thing. If we have Carolina Hard Money, when people Google hard money in North Carolina or South Carolina, who's at the top? We are. Did we pay for it? No. So I was like, yes, that's a great idea. So that's where we came up with Carolina Hard Money and started from there. However, when I first got into the business, I always tell people I am a recovering mortgage broker. I actually had a company with Larry Goins. You may have heard of him. He's a national speaker, a marketing genius, big wholesaler, has written several books. And is well worth following. So Larry and I had a mortgage company together, and it was doing great. We only did investor loans. So one of the things that I knew at the time when I first got into the mortgage business is that the only way you can separate yourself from others is to do what the other people don't want to do. And mortgage brokers were, everywhere, a dime a dozen. So no one wanted to do investor loans. So I chose to do the investor loans. I knew they were more difficult to do, but if I learned how to do them, I would be able to get that segment of business. I wanted to be known as the investor mortgage person. and that's exactly what happened. We learned all of the tricks that you had to do to get through to a lender to do the loan. And what that means is how you package the deal. It's not sending in incorrect information or information that isn't true. It's just making sure that they have in front of them what they need to make a decision quickly. Because even the lenders would put the mortgages, the investor mortgages, off to the end to underwrite because they weren't their normal thing either. So once we learned all the nuances, we really became a force in our area to be able to close investor loans. And we did awesome. The other thing that it did for me as being a mortgage broker is it allowed me the opportunity to see how much money people have. When you're underwriting a loan, it's easy to see how much money they have in the bank because they have to send those statements to you. So as I'm collecting these statements, I would have borrowers that would come to me that had lots of money in the bank, self-directed IRAs. They might have a 401k. They just might have a good savings account. But for some reason, they couldn't find good deals.
Yep.
Then I had the people that were really great acquisition folks. They could find these great deals, but they couldn't qualify for a loan to save their life. So I started putting those two people together. I'd take the guy with the money and lend it to the guy who couldn't get a loan. And so I fell into hard money. I really just fell into it. And it turned out that that was doing much better than the regular conventional mortgages. And of course, when 2008 hit and the whole world went crazy, the one thing that never stopped was the hard money lending, because now you had a completely different set of people that were coming in and buying properties. So that business just continued to go along. And as soon as things started picking up again, 2010, 2011, of course, hard money just took off long before conventional lending did, because, conventional lending is difficult and crazy, especially for investors at this point. So that's really how I got into the hard money lending. Now, one of the things that really helped me was having the ability to have no problem with asking people how much money they have in the bank. It's a lot of people, their butt cheeks tighten right up when they start talking about money, right? Wait, why are you asking? It's how you ask that makes the difference. If I meet somebody in an elevator and we start talking and they say, well, what do you do? Well, I help people build wealth. Yep. And then I shut my mouth. Oh, well, how do you do that? Oh, I lend their money out and earn interest for them.
Yep.
Wow, how do you do that? And then I get to get into the self-directed IRAs and how they work. And from there, most people have self-directed IRAs. Most people have some sort of IRA now. Previously there wasn't a whole lot going on, but really since 2010, 2011, you really see more and more people investing in self-directed IRAs. And you've talked to, Quincy Long with Quest and several other people who run IRA companies, how much money is sitting in those companies and they're not doing anything with it.
Yep.
So lending offers a great opportunity to be able to gain wealth in their self-directed IRA. And it's either tax deferred or tax free wealth. If it's a Roth, when that money goes into their Roth, the interest payments go into the Roth, they've already paid taxes on the initial amount that they put in there. They don't pay taxes on the interest, period.
Yep.
So it's just such a great way to build your wealth. Problem is most people don't know how to lend the money, who they lend it to, what the documents should look like. And then they're afraid, what if I have to foreclose? What are all those? Those are all issues that are out there. And you kind of have to step your way through it. I call them piles of poop that I've stepped in, and I've stepped in every one of them. My goal is to keep other people from doing the same.
Yep.
I have a lot of people who want to lend money. They want to learn how to do it, and I'll lend their money for them and show them what I do, so that if they've got someone that they know well, people in their local RIA group that they want to lend money to, now they're going to be a little more comfortable about doing that.
Yeah, I mean, what you're doing is an absolute necessity for this business because, like you mentioned, what you're doing is you're kind of bridge between skill sets, right? There's, the lead generators that find the deals, and that's a completely different skill set because a lot of individuals that you're working with, they may or may not have made their money within real estate. They may have made it in business or inherited it, and they want a passive return. They don't know how to do marketing. It's a completely different skill set, and you're bridging these two different worlds and making everybody win together. So it's a complete necessity to have hard money lenders within the business. Did you have kind of touch a little bit more on your background? Were you actually investing in real estate, or you were just a mortgage broker? Because a lot of individuals are rehabbers right now. They get good at raising money, and then in the back of their mind, they're like, well, maybe I can just transition to becoming a hard money lender. Is this, in your opinion, something that really anybody can do? What's the difficulty in starting up a hard money company? The costs associated with it. Is this a lot harder or easier than people may think? Kind of what's your opinion on that?
Well, for me, it was easy because I have the mortgage background, so I know how to underwrite. And it's dangerous if you don't understand how to underwrite, but that doesn't mean that it's something that you can't learn. And it's baby steps, one deal at a time. Did it cost me anything to do this? Not one dime. Not one dime. It if you're using other people's money, they're paying you to put that money out on the street for them. But it's there's so many different ways that you can set it up.
Yep.
You can have it so that you share in the interest rate that you're paying. You can have it set up so that you just get the points and the borrower gets or the lender gets all of the interest. There's different ways that you can structure it. I had mine set up and still set up this way, is that our lenders get all of the interest, and this is on our one-off, meaning they're not in our fund. Our lenders get all the interest, and we get the points up front.
Yep.
We also have renewal fees that we've added. You know, if the loan goes over the 6-month term or the 9-month term, those renewal fees are split between the lender and us. So we want it to be a win-win for everyone that's involved, including the borrower, because you don't want to take them to the cleaner so they can't come back to you again. So It's all, everybody has to be working together on that.
Okay.
Now, when you're saying, can anybody do this? Yes, and anybody can do this. However, it's also state specific on whether or not you need to be licensed or bonded, because you are lending, you're making a commercial loan. Now, they're not going to mess with you. I mean, the government isn't going to mess with you if you're doing 2 or 3 a year. That's not a big deal. But when you start doing this for a living, number one, it's a full-time job. Because not only are you worried about placing your money, you've got rehab money. You have to make sure that it's being dispersed and make sure that the work that's being done to the house is up to standard, that they've passed inspections. There's a lot of things you have to follow up to make sure are done correctly.
Yep.
If you're a rehabber, you know what all those things are already, because they concern you as a rehabber as well. So when you're a lender, you get the opportunity to learn all of the facets of real estate investing. The other thing, too, is I am so passionate about real estate, everything to do with real estate. I don't care what country I'm in. I'm always looking at, I wonder how much that house would sell for. What kind of rehab could I get done on this one? What would it rent for? Can I do an Airbnb over here? I'm always looking at real estate. I can't stop. It's a disease, but it's a great one, and it works really. So it's going to capture everything that you do.
Okay, so let's kind of go down the process of the actual hard money loan so people can kind of understand what we're talking about. So you've got, all around the country, different markets. You hear, 1.5 and 8, 2 and 12, 3 and 15. And people are like, I don't know what this means. And you just talked about points up front and points on the back. And so we're going to kind of look at things throughout this whole podcast from the lender side and then also from the borrower side. So what are we talking about when we're talking about points up front versus the interest on the back end? And you were talking about that's how you get paid, right? So let's go. We got some guests running through the background, but
yeah, my kids just showed up.
they want to be on the podcast. So it's all good. So let's talk about the points up front, and then we'll kind of go through the whole process. You talk about rehab draws, because I think a lot of investors, when they're starting out as a wholesaler, they get a little bit of success. They've done a few wholesale deals. Now they're like, okay, I'm big and brave now. Now I want to do a rehab. And then they go to the hard money lender, and quickly they realize that they don't just get a free deal if they can find a 70 cent on the dollar deal. They're going to have to leave some money in it, and it's going to cost some money up front, right? So let's talk about the points and kind of the structure of these loans.
Sure. Really what I like to do is kind of start from a third grade perspective. A hard money loan is a short-term, high-interest loan that allows the borrower the opportunity to get the money to buy the house, fix it up, and get it sold. Now, you mentioned points, you mentioned interest rates. That's what's so interesting about hard money, is it's different with everybody in every state, in every city. In the Carolinas, we can get 5% origination fee up front, and we can get 13.75% on an interest rate. I
Yeah.
can't get that in California. California, I've seen 1% and 9%, 1 point or origination fee and 9%. There are some people that can find private money, and that would be somebody that just happens to have a self-directed IRA and they want to earn money. They're happy to earn 7 or 8% on their money.
Yep.
And they'll lend it out with no points, no money out of pocket. But if that's you, then you probably have a pretty good track record of what you've done in the past, and you can show what you've done to this person that has money. One of the things I see is that as people get more deals under their belt, they get better at what they do, they can get money cheaper because now they have a portfolio that they can take to somebody, and their eyes and ears should always be open with who they meet, who they talk to, and everyone they look at, they should think of a dollar sign on their forehead and think, I wonder if this person has money in the bank that they're not earning money on and they're not earning interest on. You need to look at everybody that way and let them know what it is that you do, that you rehab houses, that you wholesale houses, whatever it is that you do. Other people need to know that, and they need to know that they can make money with you.
Yep.
So we've got the points up front, which is our origination fee. Now, we lend out based on the after repaired value, which is how everyone should look at a deal from the beginning. Everyone should look at the after repaired value. What can I sell this house for? The next question is, what's it going to take to fix it up? And then the next one is, what can I pay for it? And if you have the answers to the first two questions, your third question's already answered for you.
Yep.
So if you use that 70% rule, which means we lend up to 70% of the after repaired value. We take your list of repairs, we give it to an appraiser, and the appraiser does an appraisal based on those items being complete. So that's the after repaired value. We lend 70%. 100% of the purchase and 100% of the rehab. We'll lend you all of that money as long as you're under 70%. That's how I can get away with charging 5 points and 13.75% because the only money you're bringing out of your pocket is the closing cost at that point. Now, the reason why I do that is not so I can charge a bunch of money. It's because I want to make sure that my borrowers have money in their pocket in case something should go wrong.
Yep.
And I promise you, something will go wrong. You're going to find termites you didn't expect, water damage you didn't expect, contractors that don't show up. Oh, I know that's never true. But there's all kinds of things, right, that could pop up. And I want to make sure that my rehab or my borrower has enough money to be able to take care of that if it's not in the rehab budget.
Yep.
Because I can't release money for something that's not in that budget. And I always want to make sure that I'm never more than 70% into that deal.
Yep. So I like that you do that personally because, so guys, when you're in your own market and you're reaching out to these hard money lenders, they're all going to have a little bit different way of how they do it. Some will let you roll the points to the back end or pay part of the points up front on the back end. Some of them have different rates. And then during the process, you're going to have draws and requests. A lot of lenders are going to request a temporary down payment. But what she's saying is that she doesn't need you to do that as long as you're in at a safe number because she wants you to have that money to put into the deal because some of these lenders want you to have 10, sometimes 15% as a temporary down payment. So say you borrowed $100,000, they're going to want you to put up 10 grand in a holding account or an escrow account, just like you would, I guess a good example would be, a tenant renting your rental property. You're going to take a 1 month security deposit and hold it back. But that 10 grand could be what they need to do that deal. And if you're doing, say, 5 deals and they're taking 10 grand a piece, that's 50 grand that's just sitting there in the project. Now, they're also going to have different processes in the way that they do their draws. Let's talk about the draw process, at least the way y'all do it, because I think this is where a lot of new investors kind of get confused. They're like, well, I'm borrowing $30,000 for rehab. Why don't I get a $30,000 check? You said you're going to give me the money, but there's reasons why they don't do that. So let's talk about the draw process.
Correct. Because every lender looks at a deal as if we have to take it back tomorrow.
Yep.
I don't care who the borrower is. We look at every deal as if we have to take it back tomorrow. And if I sent you your $30,000 check on your rehab and I had to take that house back tomorrow, you have all the rehab money to finish the house, not me. So now I'm not only in the deal deeper, at that 70%, now I'm going to have to take money out of my pocket and add to it to get it finished. So I'm in it at more than 70%. Now, I care about the 70% for a reason. I want to make sure that the 30% profit is there for anything that could happen. The real estate numbers can drop. Something could be going on in the neighborhood, and all of a sudden the value isn't there anymore, and you're going to have to drop the price. But we all know that what we see as a 30% profit at the end, in reality, you're lucky if it's 20, right? You put the real estate commission in there, the taxes, the insurance, all the electricity, all the things that go in to rehabbing a house, and the payments that you're making. I mean, that's coming out of there too. So that 30% can dwindle pretty quick. So that's why we use that number. Some people use 65%. Some people will just do 50%. Will lend you on 50% of it and still make you come to the table with a huge amount of money. So it's different for everybody. There's also people that are asset-based when they're lending, and then other people who care about the borrower and their ability to pay. We're a mixture of both. We want to make sure, because we don't want your house. If we wanted your house, we'd be rehabbing. I always say that I only rehab by default. I don't want to have to rehab a house. I would much rather, I would much rather just get the money from being the lender and let you get all the profit. That's the key. But when someone's doing a draw, let me back up just a minute. The rehab money is there not to get your contractor started. It's there to pay your contractor when they finish whatever portion it is that you're requesting a draw for. So that's another reason why we don't want somebody to bring a bunch of money at the closing. We want to make sure that they have enough money to get their contractor started. Some contractors will start without any down payment. If you find one of those, keep them and pay them well, because they're not common.
Yeah.
You're going to have to pull money out of your pocket to get them started. So really, a draw request is a reimbursement of what you've already paid out.
Yep.
That's really the way they're set up. In addition to that, every time you request a draw, an inspector, somebody has to go out there and look at it and make sure that not only that the work is done, that it's done in an acceptable manner. I can't tell you how many times that I've gone out and done inspections and the tile looks like my third grader did it. And it may be that the borrower is out of state and doesn't get to see the quality of work. I'm their eyes and ears walking in that property, making sure that that work's done like it needs to be done. And if they've got the contractor sending them pictures of what they're doing, pictures do not tell the truth. You can't tell that the tile is wavy and it's supposed to be, straight. You can't, they'll take a great picture of the corner of the room with that one window that they replaced, but not the other two that they failed to do. It also makes sure that if someone makes a draw for cabinets need to be actually screwed into the wall. They can't be in a box. They can get on a truck and leave. Ask me how I know.
Yeah, and I think investors are notorious for being transitioning to being high-level photo takers and making something look like it's done when it's not, because they run out of money and they're like, I need this next draw. So basically, guys, what's happening? Say you borrowed $40,000 for rehab money. She's going to hold it in account. You're going to have to go spend the first $5,000, prove that the work's done accurately and correctly up to her standards. Then she's going to release $5,000 back to you. Then you spend $5,000 again, or they all work a little different, and some charge you a fee when they come out. One of the things I want to point out is, they do that for a reason. And a lot of y'all are amateur private lenders, or you're thinking about lending to even a friend or a family member. Be very, very careful. Multiple times this past year alone, I've known a few individuals that really got burnt bad by doing this, because they lent on houses, let's say, where their investor was buying it for $50,000, it needed $100,000 in rehab, and they were going to sell it for $250,000, so the numbers look good. So they loaned all that money, and that investor took the check for $90,000, $100,000 in rehab, and then guess what happened? the work didn't get done. Now they're
That's
going to have to
right.
foreclose on the property that they're into, so it's not a good situation. Um, so be very careful doing that. The other thing is, while I'm on this, I don't know if y'all are seeing this here in Dallas. A few times, title companies and other companies have been their emails have been hacked. So when y'all wire money into a title company or hard money or even hard money lenders, or you're doing any type of transaction with bank wires, please confirm over the phone, not through email, where you're wiring the money, because you don't want to see that money disappear halfway across the world. I don't know if y'all are seeing anything like that, but
Absolutely.
that's
Yeah.
become an issue down here, unfortunately. Okay, so what she does is a necessity. Now, how can you help someone on the other side? So we talked about a little bit how you can help an investor who needs money. What about someone who has money but doesn't know where to place it? Because it can be frustrating. People think just because you have a lot of money, it's easy to reinvest it. It's hard to keep that money in play working over and over. You do have a couple options. You have a fund, plus they can lend on a per property basis. Let's talk about how someone who wants passive income can work with you in Carolina Hard Money.
Okay, great. So we do have a fund for accredited investors. Right now, that fund, since inception 2 years ago, we are earning 11.5% year to date.
That's really good.
Or since inception to date. So yeah, we're pretty happy with that. We also have the opportunity to lend in what we call one-off deals. And that's where we'll take, and our minimum on that's $100,000. So if you have $100,000, you want it to earn some money, we'll literally put you as the lender on the loan with for a rehabber. And our average loan amount is $356,000. So if you have $100,000, you're most likely going to be in first position with somebody else. And we oversee the placement, the draws, everything. And if something should happen and we have to take it back, I oversee all of that as well, making sure that it gets foreclosed on, completed. We definitely would try to get a deed in lieu before we have to go through the foreclosure part. But we always make sure that everybody's working together. That's the key. So we have that available now. An accredited investor, a lot of people don't know what makes you accredited. You have to have an earning of $200,000 a year. For the past 2 years, I think it's $300,000 for a couple. For the last 2 years, or you have to be worth $1 million, not including your primary residence. So if you have rental properties and things like that, as long as you are worth $1 million, you can be an accredited investor as well.
Yep.
So we do have that available. And I do want to kind of touch on something you brought up a little earlier. If you're lending and you decide to lend on your own, it's a great thing to do. You just need to make sure that you take the right steps. I recently took a house back, deed in lieu of foreclosure. And even when I do that, we go ahead and pull title as well. You're not going through an attorney to do the deed in lieu necessarily, and you don't have to pull title, but we do it anyway because there may be mechanic liens on there that you don't know about. They may have gone out and put a second on the property.
Wow.
And if they've done that, you take it back deed in lieu of foreclosure, that second moves in front of you.
Yeah,
if they're recorded.
That's scary.
So it is scary, and people do it all the time. So this one that I just took back recently, a guy had purchased another business, a FedEx route. In addition to the real estate, he has shiny object syndrome. Ooh, that looks like a good way to make money. That looks like, and he's been an investor of mine for 8 years. So it's somebody I've known, but he just got all wrapped up in there that FedEx just, sucked his money dry. And he called me and said, I can't do this anymore. What can we do to save this? So, and he told me that he had taken out a second as well on this property. So, so instead of going through the foreclosure, I called the person that had the second in place, and I negotiated them to take a much lower payment. That was a $25,000 deal, and for them, and I negotiated that they take half of that because there was enough room in the property to do that. Now, it was never recorded. It never pointed to the property. I could have just said, "Too bad, so sad. See ya." And she said, "Well, gosh, we're friends. I didn't think I had to do all that." I don't care if it's your mother. You need to make sure that you cross all your T's, dot all your I's, record everything. If this guy had been hit by a bus, nobody would have ever known that she had placed a personal second on that loan,
Yep.
on that property. And she would have gotten nothing. If she had been dealing with anybody else, she would have gotten nothing. But I certainly wouldn't want somebody to leave me hanging. If I had a second and they wanted to foreclose, I would much rather them try to work with me to at least get something back. But she left herself wide open for something like that. And it's because she didn't know. And she didn't think to ask. Everybody can pick up a phone and call an attorney just to ask a question or two. You can Google on any real estate investor association website or blog, and people will answer questions like that for you. So
Yeah.
there's no excuse for, and that's a lot of money, 25,000 she could have lost.
Yeah, I think that's some really good advice that you gave. So this is why we have great guests like Wendy on here, because that's something that I never even thought of until just now. And so now you got my mind spinning. So you gotta be careful because you don't know what you're taking back. And also, like, you know, just like she said, don't lend your mother. We're not going to name names, obviously, but here in Dallas, there's a very prominent big name investor that was investing with his brother for a long time. And the one ripped the other one off for like millions of dollars. And they worked together for a very long time. And then all of a sudden, out of nowhere, after like 20 years, this happens. So always document everything. Make sure you have everything done correctly. And the little lawyer fee that you have to pay to draw up your documents could save you hundreds of thousands of dollars. So it's worth it.
Absolutely.
What about, so say someone does say they're in Ohio, right? And they want to lend money. Do you do consulting for people? Is this part of anything that you're working on? Do you help them with the paperwork, or is there an option for that? Because I know a lot of people, that's probably the biggest that's probably the biggest thing that's deterring people from doing this is they don't have the paperwork, and it scares them because they don't know if, they're lending a lot of money. They want to make sure they do it right.
Right.
Can you help with that, or is that something you do?
I am not an attorney. Let me make sure I say that. I am not an attorney, but I will say that documents, whether you're a deed of trust state or a mortgage state, that kind of thing, it depends on your state. And you are always better to have a local attorney draw up those documents for you. All you have to do is give them the terms that you want, and the attorney can draw up those documents for you. Once they've drawn them up one time, now you have a copy of what you can use.
Yep.
So that's something that can be done. And you also want to make sure that you follow what other people in your area are doing. If everybody in your area is charging 3 points and 10%, then you need to probably do the same.
Yep.
It's localized in that respect. The other thing that I always tell people in any kind of real estate passion that you have, your local real estate investor association is the cheapest, deepest education you will ever get. It's a great way to plug in to what's going on in your area. It's a great way to sit in the back. I remember back in the early 2000s, there was a guy that would show up at our real estate investor group called Metroline Area, and he was a good old boy, wore overalls, and always was chewing on a piece of straw. Always. And he'd lean in the back of the room up against the wall. He wouldn't say much to anybody about anything. Didn't have a whole lot to ask either. But by the end of that meeting, he'd tap the shoulder on one or two people and say, "I've got money to lend if you're interested, if you need to borrow it."
Yep.
What he was doing is he was looking to see who the movers and shakers were. He was looking to see who the successful rehabbers were in the room, or transactional lending that needed to be done. He was looking to see who was doing deals.
Yep.
And that's what he would do. It was just amazing to watch him, because you think, what's this guy doing here all dressed like that? And so,
well, yeah.
When I tell people that if they're interested in kind of getting started in their own area, first of all, lend in your backyard. Don't lend in a place you don't know or that you can't get to in 30 minutes to go in and take a look. Even when somebody's giving you due diligence on a property, comps, that kind of thing, do your own due diligence. Well, do it just as if you were buying that house for yourself.
Yep.
So you need to go through all those same motions. Go underneath the house in the crawl space if there's one. Go up in the attic and check out the attic. Make sure that whatever rehab list they give you that they're going to do, make sure that everything that you saw is on that rehab list as well. The other thing I tell people is if you are interested in lending money, I would have a t-shirt made that says "Got money?" with a question mark. Like the got milk, and I'd wear it those meetings, just letting people know that I lend money.
Yep.
People will flock to you, and when you're interested in doing a loan for somebody, let them give you all the information that you need to do your due diligence with, and you can tell how organized they are by the things that they'll put in front of you, the pictures, the comps, the reporting, plans that they're getting ready to do, all of that. The more organized they are up front, you can pretty much count on the fact that they're going to do that when they're making their payment every month too.
Yep. And so, like, you can never judge a book by its cover. And it's funny that you brought that up because you see this all the time, especially at the REI clubs, guys, because it's never the guy in the front that's got a nice suit on that's really loud and vocal trying to present himself and wear the mask like I'm the successful investor. It's always the guy in the back with long hair, pajama pants, and a Hawaiian shirt that's worth $50 million, right? And you just always treat people with respect because a lot of people would have blown that guy off, right? And he's the guy that could have helped them get to where they're trying to get to. Now, let's talk about your fund versus the hard money loans that you do on one-off. What is, after looking at a lot of people coming to you, what do most people gravitate towards? Because you can either keep your money in play, you said 11.5%, where you're loaning your money to the fund and you're getting that return all year, or you can loan on a one-off and get a higher interest rate, but you get a promissory note and deed of trust on that property, but your money may not be in play all year, right? So you're having to put it in. Okay. Yep. So let's talk about, obviously we're not giving you legal advice here, but a lot of people struggle when they're getting new in the business. They don't understand what a promissory note is. They don't understand what the deed of trust is. They don't understand, the deed. Let's kind of break that down. And then what you see most people gravitate towards when they come to you, your fund or the one-offs, and the benefits of both.
Well, first of all, we're going to look at it from an accredited situation because you have to be an accredited investor to get into the fund. One of the reasons why the fund is the best deal, because when you put money into the fund, the majority of the people that are in that fund, and it's paid quarterly, the returns are paid quarterly, that money is compounded. It stays, they leave it in the fund and it gets compounded. So by the end of the year, really, when you're looking at every quarter, because your interest is now making interest on interest, you're really looking at you personally, you're looking at 14, 15, 16% on your money. So it really, really increases. If you're in a one-off loan, what that means is that you, Connor, are the bank. So the borrower is paying you direct. That interest goes into your account. You're the lender. If anything should go wrong, that house is yours. It's not like being in the stock market. The stock drops and boom, it's gone. You'll never get it again. You've got that collateral. You just have that same collateral in the fund, but it's an LLC. You're a member of that LLC. So it's all you. Now, on the one-off too, if something should go wrong, if that borrower can't pay, you have to take the house back. You're the one standing there holding the bag, needing to make sure that it gets foreclosed. Now, again, I'm overseeing all that, but you're the one that's not earning any interest during that time frame when the house is getting finished and it's getting sold and that kind of thing. So you're taking a bigger risk. Now, you're earning 13.75% on your money, but at that point, you're not earning anything because your money's stuck, and you're the one on the hook. The house doesn't make the money you think that you thought it was gonna make, then you're the one taking the hit.
Yep.
When you're in the fund, it's spread out over a pool of people. So, and there's a contingency clause or a contingency account inside the fund that takes care of things like that. So we expect things, we expect something to go bad. So we're prepared for it. And we have that money set aside in the fund to begin with. And you don't even know that stuff like that happens. All you're doing is looking at your quarterly returns. So it's a blip on the radar versus when it's just you. So there's the difference. Your risk is just a little bit different. The
Okay.
other thing is, even though you're making 13.75%, if your loan gets paid off in 6 months, then you have to put your money out again. And it may be a couple months before we get it out again. You amortize that loan over a total 12-month period, then your return is probably going to be a little lower than the 11.5% because your money sat idle for a little while.
Yep. So that's good. Thank you for explaining that. So, okay. So if they decide they want to go into your fund, what are there limitations on, do they have to leave their money in for a 12-year minimum? Is there exit penalty? Because I mean, obviously it's a pain for y'all to have money coming in and people just going, oh, well, I changed my mind. I want my money back, like, overnight. What are they looking at if they're interested in contacting you and putting money into your fund? Like what can they expect when they're looking at doing that?
Well, and I'm glad you asked about that, because we could have like a whole different talk on just funds and how they work too,
Yeah.
because they're all different. Just like we talked about, you can structure your deals differently. You structure funds different as well. Our fund is an evergreen fund. We don't really have a limit on how long the fund's going to be up and running, because we want it to keep going. Some funds only have a 5-year term that it may be a development for an apartment complex. So you put your money in for 5 years. At the end of 5 years is when you'll get your return. Everybody gets their money back. Our fund, because we're perpetual like that, we have a 2-year commitment on it. So you put your money in there, you're in there for 2 years. Now, it's at our discretion. If you run into a hardship, you need to get your money back out, we'll certainly work something out for you on that. We don't want to make it worse for you. But for us, it is a 2-year commitment, and it's paid quarterly on that. The other thing is, when you look at funds, is the way management companies, the people that manage the fund, how are they paid? How are the funds distributed? Like when a loan closes, who gets all the points? If you're charging 5 points and 13.75%, does all of that go into the fund? Well, not in our case, because our fund management company is not the one actually making the loans. Carolina Hard Money is. So the first point goes to Carolina Hard Money to pay for their work for underwriting the loan and all the employees that it takes to underwrite the loan, to go out and obtain the loans and that kind of thing. So then the remainder of that, the 4 points that's left over, and the interest rate, that goes into the fund. And that's split in different ways. 40% goes to the management company, 60% goes to people that are in the fund. We also are an LLC. So at the end of the year, you get a K1. So you're a full participant in that fund. That's the way ours is set up. There are other funds that are set up differently. So those are great questions, and they're questions that need to be asked. When you're talking to anybody about a fund, there's usually two complete packages of information that you should get. One would be your regular term sheet, which is basically a summary of what the fund does, what they invest in, because you decide exactly what you're going to invest in, where you're going to invest. Our fund, we don't do seconds in our fund. We can't do a second in our fund. I can do seconds, but I'd have to use a one-off borrower or a one-off lender to do those. So we decided we didn't want to have seconds in that fund. So there are certain things that in that term sheet, you're going to know what that fund can and cannot do, and what it is we invest in. Is it a long-term deal, short-term deal, those kind of things. So that's the term summary sheet. There's also something called the private placement memorandum, which is great bathroom reading. There are probably 150 pages of legalese. That is actually the details of the term sheet. So one will point back to the other. But whenever you're looking at any fund, make sure you don't really want the PPM, the private placement memorandum, the whole thing up front. Get the term sheet up front just to see if it's something you'd be interested in.
Yeah, you guys stop.
And that's 50 pages.
Yeah, they should all stop taking their sleeping pills at night and just read the
Yeah,
PPM and get
that's
the
right.
education and go sleep real quick and easy. Um,
That's right.
so that's a pretty good option. So for those of you who want to leave your money out long term, just set it and forget it. Make passive income. That's probably your better option. Now let's talk about one more thing before we let you go here today. Um, Investing with y'all out of your 401k or self-directed IRA, is this a possibility? Because a lot of people have that money. So like if they're an active investor or they're thinking about being an active investor, they don't want to tie up their actual cash in a long-term investment because they want to cycle it. They want to keep it in and out, in and out. But if they got a lot of money sitting in an IRA, they can't really do much with it, and they'd rather just kind of let it sit out there. So is this something they can invest out of their IRA working with you guys?
Absolutely. Absolutely. We have a lot of self-directed money in our fund. In addition to that, and I'm glad you brought that up. When you invest any kind of IRA or 401k money into a fund, you need to make sure that the fund itself is not borrowing money to help leverage themselves.
Yeah.
Because if they are, what that means is you're going to pay UBIT, unrelated business income tax, on that money from the earnings that you're getting. Even if it's a Roth, you're still going to pay that. So make sure that they aren't leveraging that account. Now, we do have in our terms the ability to be able to leverage that account, but we've chosen not to because we have so much self-directed money in there. We don't want to make these folks have to pay more interest on what's supposed to be tax-free or tax-deferred money.
Yeah, which is why they're investing out of their IRA in the first place, is they want to get
That's right.
a higher return.
That's right.
Okay, is there anything that we didn't touch on that you think is really important for someone who's either standing in your shoes as a lender or as an investor that's coming to y'all that you want to kind of go over here real quick?
Well, gosh, what do we have? Another 3 hours? Is that it?
Well, yeah, we're going to about like we got actually longer than that. You need to go get some coffee.
There's so much we could touch on, and I just want to encourage people not to be afraid. So many people suffer from paralysis of analysis, and they try to get all the education they can, but they don't take a step. You need to take the baby steps. Try with a little bit of money. Try with someone that you know, like, and trust. Loan money to us and see how that works for you. You've got to give it a shot and see what works. It's like the story of the talents, parable of the talents in the Bible. Are you going to bury that money and not let anybody touch it? Or are you going to at least give it a shot and try to build wealth with your money? You need to do your homework and do the right due diligence, but burying it in the ground will assure you that you get nothing.
Yep. I mean, like if you hold your money tight like this, guys, it's never going to leave your hands. So you got to open up, let those soldiers kind of go out there and fight in the field and come back with some friends. Because if you never let it go, how can, money can't come back in that hand if you never open it up, right?
That's right.
So Wendy, I'm grateful to have you on here today. I think you gave a lot of good information. What's your website? We're going to put all your links below. And if you want to give out your phone number or your email address, we can put that on here as well. So I'm sure somebody watching this is going to want to contact you about either investing in your fund or just some one-off deals. Because I think getting double-digit returns is a good return on your money. Most people have been in the stock market for 20 years and are still trying to get even, right? So
right.
This could be a great way to go about increasing your retirement or really just making a good return passively, right?
Absolutely. If you're interested in learning anything about the fund, my brother, who's my partner, is the one who raises the funds. He's the onboarder of funds, and I'm the person who puts it all out on the street. So his email address is bill@carolinahardmoney.com. And I'm happy to answer any questions. If anybody has any lending questions, whether they want to be a borrower or a lender, and need some help or some advice, I'm so happy to help. Best way to reach me is by my email, which is Wendy@carolinahardmoney.com. And our website is, can you guess it? carolinahardmoney.com.
It's a pretty good name. I'm surprised y'all got that, you know.
I know, I was thrilled.
All right, well, Wendy, I appreciate you coming on. You're the best.
Thank you.
I think what y'all are doing is great. And, you know, a lot of these lenders want to take too much, but I think that's why they struggle getting money. And it's a win-win situation working with them. And I know a lot of people that do. So, guys, appreciate you listening today. I'll see you on the next episode of the Investor Army podcast.
Thank you.